I'd like to introduce you to Viniti Sambre. So as I mentioned earlier in my presentation, India Avenue works in partnership with locally based fund managers who provide advice to us on stock selection and help us to build our portfolio. Today, one of the newly appointed advisors of India Avenue is a fund manager called DSP Investment Managers. Viniti Sambre is responsible for the mandate between India Avenue and DSP and is the head of equities at DSP and has been at the firm for 15 years. So what we'll do is we'll have a session where I will ask some questions and Vinit will be able to share his presentation or answers, and you will have the chance to please leave your questions in the chat box, and I will ask him those questions at the end of the discussion. So Vinit, are you there?
Yeah, hi, good morning, good afternoon, Mukundan. I'm here. Thank you very much for inviting me today.
Thanks very much for coming on and making time for us. I thought we could get into the first question, which is, can you please provide the history of DSP and yourself in Indian markets and talk a little bit about the essence of DSP's investment philosophy when it comes to investing in Indian equities?
Sure. So I'll just start off in terms of the organization DSP. We go back actually very long in terms of our history. DSP as a group actually was formed 15 decades back, and the current generation is the 5th generation in the business. So it's a very long history in terms of the organization itself. And in terms of the core business, the focus has been today on asset management only, while the group had various business, investment banking and the other stuff, which actually led to many of the corporates coming into India. I mean, we were one of the pioneers to get almost 300 companies to get into the capital markets. But right now, today we are just holding on with the asset management company. So it's a very focused approach to what we are doing right now. The ownership actually allows us to think long term. It's a family-owned business, but professionally managed. So from the family, we have Mr. Hemendra Kothari and her daughter as well. But in terms of the managing director and CEO, we have a professional Mr. Kalpen Parekh. So that actually brings in a good blend of how to believe and think long term. We've had 2 really long joint ventures, one with Merrill Lynch 1996 to 2006, and then 2007 to 2017 we were partnered with BlackRock. So I think 2 decades of good practices to understand from them. I mean, that's and now since 2018 it's a family-owned firm. We bought over the stake of BlackRock. So that's the history with the joint ventures. I mentioned about the corporate access. We have very good corporate access because we were instrumental in getting so many corporates on board into the capital market. And by virtue of the experience of the team member, it's a 25 members strong investment team. All of these are very well experienced in the Indian capital markets. All of these also carry strong experience and relationships. So I think that's the background in terms of the assets under management. Today we are closer to about $17 billion of asset under management, of which roughly about 12.5 billion is under equities, of which domestic is about 10 billion, and the offshore mandates which we are running is $2.5 billion. So I think that's the brief background about DSP.
Okay, thanks for that, Vinit. If you could now talk a little bit about the investment style that you have worked with during your career, and how you seek to apply it to investing in equities in India.
Sure. So first, I will just talk about myself in terms of my own historical background and the past track record. So I have been in the capital market since 1998. I'm a chartered accountant by profession. And I'm with DSP Group since 2005. So it's 17 long years of association with the DSP as a group. And in terms of the market cycles itself, I have personally experienced 4 major market cycles. And I would say that, having experienced in the initial phase of my career, the dot-com boom and bust, I think that was one of the good experiences to sort of understand how the cycles behave, how the build-up of narrative takes place, and how things when it goes bust, what the risks can actually emerge. So I think those were very good years in terms of imparting strong learnings as to how should one think about the markets. And then we had the Lehman crisis, which were also instrumental in giving out some thought process around these market cycles. So taking all of these experiences together and working with some of the very fundamental investors early on, what I've understood is the way to sort of create wealth or generate wealth. It has to be a long-term approach, which is what I have followed. Buy and hold approach is something which we have followed. Our portfolio turnovers are pretty low, and what I've understood is that one requires a lot of patience after having invested in good businesses, to see them grow and to see them create wealth. And one needs to sort of cut noise, which keeps coming up every quarter and every day, actually, as some of these news and developments keeps taking place. But the core thesis has been to focus on good companies managed by very capable and passionate managers, by businesses who have really understood the importance of allocating capital, and capital efficiency has been one of the core criterias of looking at each of these businesses. And I think over a period, holding on to such companies for a long period of time has been one of the ways in which the wealth creation has happened. So that's briefly my background, and I will just sort of delve more into the investment philosophy. In terms of the philosophy itself, as I mentioned, the focus is on sustainable long-term wealth creation. What we look for in companies is a long runway available for growth, which means the businesses needs to be scalable wherever we believe the opportunity is large. We would like to own the leading companies or the companies with very strong moats within those businesses, and which we believe over a period of time will outgrow the category and run the business in a very capital efficient manner. So we focus a lot on the ROEs of the company. There are other metrics as well to focus on, but ROEs and incremental ROE is important criteria. A good amount of thought actually goes into the capital allocation strategy of the business, because that is something which will determine the future of how the company is going to shape up in terms of the business itself. While we these are important aspects, management is also one of the important aspects. High quality management, good governance is something which we would clearly like to follow, is what we believe is also one way to avoid a lot of accidents. And as much as we feel managing money is all about selecting companies and good businesses, it is also about eliminating companies, because for every 1 or 2 companies, you will have 3 or 4 companies which will create or destroy wealth. And there are certain characteristics of businesses which we believe also are responsible for destroying wealth, and we try to stay away from such companies wherever we believe there is a capital misallocation history, there is a disruption which is taking place, or regulatory headwinds are emerging. I mean, those are the clear areas where we have sort of stayed away from the companies. So I think that is in brief, the philosophy, and I can get into the details of it, but this is in brief, as I can say, in terms of the broader philosophy.
Okay, thanks, Vinit. If we move on to the next question, then there are, a significant number of asset managers in India. The industry has evolved over the last 30 years. Where do you see DSP's unique IP or advantage relative to its peers in the marketplace?
Yes, so as I was talking about as a firm, the focus is on the asset management business. So we are very focused as a company. What we want to sort of work for is really in the interest of the investors, and asset accumulation or asset gathering is not what we sort of keep aiming for. Our focus hence has been on creating long-term durable alpha, and which is what I believe is clearly from the investors' perspective what we work for. Whatever frameworks we have sort of followed in terms of the investment, we have clearly laid out and articulated our documents, which carries very minute details of our framework. What are the qualitative metrics? What are the quantitative metrics? Now, this is hardly what we see within the peers, but this is something which actually helps our investors understand how we are going to sort of manage the money versus focus just on the outcomes of how we are managing the business. So I think what we are trying to make easier for the investors is to understand principally how we are sort of going to manage the money, what are the kind of companies, businesses which we are going to own, where are the pitfalls which we are going to avoid. And I think that in a way allows the investors to get a clarity of where they are actually allocating capital. So that's something which I would say that we have, we are very focused on that. The other important is minimize the risk. We within our team, we have a skeptical analyst whose job is to look for companies or any governance issues within any companies and flag it off early on, so that we are able to avoid some of the major issues which, if any, are cropping up. So this is again a role which we believe is an important role, and it's very difficult otherwise. When one is looking at company as an analyst, one gets biased with the story, and you need to sort of keep having someone who is actually working as a skeptical analyst or counter check and doing a lot of the stuff which normal analysts generally would sort of not have seen. So in terms of the private companies which are associated with the companies, are there related party issues, getting into the details of those. So I think all of this actually helps us understand the risks which are actually emerging early on, and allow us to sort of be more vigilant there. In terms of the other aspects, we are looking at working on a responsible manner in terms of investment. We are signatory to the UNPRI. We are sort of trying to build the ESG frameworks also into the portfolios. That is something which I think is getting relevant. In terms of the other aspects, there is a owner's mindset. There is a stock ownership which is there for the employees after the BlackRock split took place. And most of the money which the employees or the family invest is all invested into DSP funds. So in a way, I can say that there is a good amount of focus. There is an alignment with the investors, and which is what we believe probably makes us more relevant from the investment management perspective.
Okay, thanks, Vinit. we can move to the next question, which is, if you could go through your case for your highest conviction positions at the moment at a high level, and why you like these companies in the context of the upcoming investment horizon, given that you mentioned you don't have too much trading and you tend to focus on longer term thematics. So if you could talk about these three positions in that context.
Yeah, I would surely love to talk about the top three positions. But before that, this is what I've showcased here on the screen is a very brief snapshot of what we are actually owning. And frankly, most of the companies we own here are high conviction companies for me. Each of these companies, I believe, are leading companies within their categories itself. Each of them has very strong moats which has allowed them to actually outperform in the past, and each of them qualitatively stands very high in terms of various metrics, be it the cash flow, be it the ROC, be it the management quality, be it the growth itself. So I would say that this is how the portfolio is split today. We have roughly about 22 odd percent into financials, with ICICI Bank being the largest. Cholamandalam Finance is one of the others, NBFCs, which comes from a very renowned house from the south of India, the Murugappa Group, and actually the company is taking a lot of new initiatives and trying to actually get the benefits of fintech imbibed into the business, which is actually, I believe, would not only drive the growth but will also lead to re-rating of the company. The second basket we have is consumption. Mukundan, you were talking of the India demographics and the benefit of that. I would say that we totally agree with you. The India's population or India's demographic is a very positive factor for India's consumption growth over the next decade. We have probably the youngest population. The dependency ratio is low, and more importantly, I think the population, there is a rising income trend. Aspirations are high, penetrations is low. This makes a case for India's consumption story pretty strong. The buckets of consumption will keep changing on a short-term basis, but I think largely the consumption is something which is here to stay. So we have investments into automobile companies here. We have investment into the food retailing businesses here. So I think that is something which we believe in terms of the growth matrix itself has to do well. We have almost about 20 odd percent exposure to IT. Again, here we have a clear distinctive advantage in terms of the cost matrix. What sort of should work in our advantage or favor over the next 3 or 4 years is a massive growth which is happening because of the digitization and cloudification of most of the businesses. And India actually stands out in terms of the cost metrics, in terms of the outsourcing benefit which these companies are going to see over the next few years. And most importantly, I will show one slide on Infosys, but most importantly, I think the large companies, they do have levers to control the cost in a rising wage environment. That is one of the risks which are emerging. But we've seen the large companies do have the power or the strength to actually manage the pyramid in a way that they are able to maintain the profitability. So that's something which is almost about 19-20 odd percent. There's a strong growth which is happening as far as the capex cycle is concerned. Government is pro growth. There are a lot of initiatives which the government has taken to support growth. The housing demand itself is doing well, and the best way we believe is best way and the safe way and a qualitatively better way to play some of these growth matrix is through the cement business, and we own one of the largest cement player in India, Ultratech. So that's about 7 odd %. We have insurance business, which is again low penetration in India. We believe the growth in the insurance is still going to be upwards of 15% over the next few years. And we have the sort of lowest cost company here, SBI Life, with one of the best metrics in terms of the growth margins, valuations. So that's about 6%. Healthcare is something where we again have a globally competitive, we are globally competitive. We have companies who are serving not only the Indian markets, but the international markets as well, including the largest market, which is US. So Cipla and IPCA are amongst our formidable companies which we own. Again, in case of pharmaceutical, there's a huge amount of cash flows which these companies are generating. Most of the companies are seeing inflection of their ROEs, and also in terms of the valuations, they are pretty reasonable in a generally slightly expensive markets. A few pockets of markets expensive. I think this is one pocket which is very reasonable in terms of valuations. We have utilities, industrials, and agri. Agri, I believe, is a large opportunity again in India. Of the total arable land, which is about 150 million hectares, what we own, just about 50 odd % is irrigated today, and there's a huge potential which is coming up. We've seen, the farmers are getting educated. The companies are becoming innovative in terms of launches of new product. A lot of registrations are taking place, and I think again we have one of the leading companies out there, which is again coming from the same group as Chola, which is a Murugappa group, and they have proven their track record in the past. So that's something we own. So I think it's a good blend and mix of businesses which we believe will keep outgrowing the markets over the next few years. Most of the companies are having strong cash flow generations. Most of the companies are having ROE upwards of 15-16%, and that I think is a good combination of ingredient which makes us believe that these are the businesses which will allow us to create a good wealth for the investors. So I think that is broadly what we own, and as I said, we have high conviction in all of them. But moving on to just sort of giving some more details of the top ideas in our portfolio. So the first idea I wanted to talk about is ICICI Bank. So if we actually look at what has happened in the bank, is there is a big transition which has taken place for the last 2 or 3 years since the new MD has actually taken over there. On all parameters, the company has improved quite a lot. Most importantly for the banks, actually, the raw material for the banks is the cost of capital. And if we look at the cost of capital for ICICI Bank, it has actually come down significantly since 2019, which makes them very competitive as far as the lending business is concerned. If we look at the credit growth, it has actually matched what HDFC Bank has done till third quarter. We believe that they are shaping up quite well in terms of the growth metrics. The profitability has improved. Their core PPOP, or pre-provisioning operating profit, as a % of assets has actually stepped up from, let's say, a 2% range to 2.3% range. So that's a good shift which has happened. The net non-performing assets has come down. So the balance sheet is good. And we are sensing credit growth improving. I think the March quarter itself is likely to show good credit growth. Plus the value of subsidiaries which they have sort of created makes a good case for this bank to sort of re-rate and narrow the valuation gap versus HDFC Bank over the period of time. So this is what is one of the top weight for us in the portfolio. Next is Infosys there. Again, what we are seeing is the growth metrics is improving, while there are still concerns whether the 15% rate of growth would sustain or no. Our sense and belief, and talking to many companies out there, we get a view that over the next few years, next 2 or 3 years, this high growth would sustain. There's huge amount of technology adoption curve, which most of the companies are moving up, and I think that's going to benefit Indian companies. We have seen the on-site wages go up significantly, and that again makes the case for offshoring even more powerful and strong. All of that actually is seen in terms of the TCV, or the total contract value for Infosys, the bottom left chart, which actually suggests an up move in terms of their new contract booking. I was talking about the ability of the large companies to maintain profitability despite the challenges. We've seen that the company has maintained their margins quite well, despite the wage cost, because I think the large companies, they work like a factory. They have they have a pyramid to their advantage, where they can hire a lot of freshers, a lot of people. Even if they leave, many actually join in somehow, and they are able to make the pyramid work in their advantage, and which is where the ability to maintain the profitability is higher. So I think that's something which works in their favor. That's the number two company. The number three company which I was talking about is the proxy on infra and housing, which is the Ultratech Cement. Now, this is the largest cement company in India, and if we look at the market shares, it has been constantly on a constantly moving higher, from 14-15% to 20-21%. In terms of the cost levers, they still have good cost levers, which they can actually benefit from over the next few years. And I think that is something which will allow them to improve the profitability. The third important aspect is that despite this company having seen capacity expansion taking place, the balance sheet has become even stronger. The debt has, in absolute terms, also come down. In terms of the debt to equity also, it has actually come down from 40-50% to 70-odd%. Plus, in terms of the diversification, they are very well diversified into the length and breadth of India. So we believe that with whatever the government is actually carrying out in terms of the push for the capex, the housing growth which is taking place, and the improvement in the manufacturing which is taking place, all of this actually will help the cement companies. And we believe this is a better way to play this whole capex, instead of focusing on infra companies, where the reconciliation of cash flows becomes a difficult task. I think here we have a clean balance sheet, we have a clear pathway, and there is room for cost optimization as well. So I think that is how we are sort of looking at companies and businesses. So these three are examples, but we can talk about the others as well.
Okay, thank you. It's always interesting to see another bank apart from HDFC Bank, which tends to feature in most emerging market portfolios or Asia portfolios over the last decade. So, I think it's also signifying perhaps that the shift has been from retail towards corporate, with a view forward from here. So I see a bank being at the forefront there, more so than HDFC. Finally, the last question before we turn it over for some questions is, what's your outlook for India's equity markets over the rest of this decade? And where do you think your outperformance will come from in that environment?
Sure. So I was actually listening to your some of the views which you shared, and I think broadly on similar lines, I think as far as the next decade is concerned, there are a lot of things which are happening in India, and there are some things which naturally benefits us, like our demographic, which is in our favor. You mentioned about the dependency ratio. I think that is helping us. Our median age is 28 today, which actually means that our we've not aged out, and I think that is something which benefits the consumption in the long term. We have stability at the center in terms of the politics, and I think that is a very important aspect. It actually gives a good visibility of the important reforms which the government is carrying out and proposed to carry out. And here actually I wanted to sort of also lay down few important aspects of the reforms itself. I think what we have seen post pandemic is a very strong slew of reforms which should help the economy sustain high growth over the next decade. And some of these, I would say, have been the COVID has turned out to be blessing in disguise. Pre-COVID, most of the reforms which the government had initiated were more of, let's say, cleansing in nature. When we talk about demonetization, banking sector reforms, most of them were of nature which was bringing about more cleansing of the economy, which actually restricted growth to some extent. And then I think just before COVID, when the government announced the corporate tax rate cut, which made us globally competitive in terms of the tax rate, I think that was a starting point where the intentions of the government were clear. They wanted to support growth, they wanted to support the private sector, and I think that is something which now we are seeing a large part of what the government is doing, be it in terms of the PLI scheme, the focus on infrastructure, and within infrastructure there are so many new areas which are actually sort of now coming up, be it data centers, be it renewable energies. I think all of these are going to take up a huge amount of money towards investment, and that's going to sort of drive not only growth over there, but it leads to employment, it leads to more consumption eventually. So I think this is something which makes a good case for us to improve in terms of the visibility of growth. The other important aspect is manufacturing itself. Manufacturing, as you mentioned, is let's say 17% of our GDP, which roughly for a $3 trillion economy, it's about $450 billion of manufacturing. But what we are talking about is 25% of our GDP to the manufacturing share to be. And if the GDP goes from as we move up from 3 trillion to 5 trillion, that actually should be $1.25 trillion of manufacturing is what we are aiming for. Now, this is a massive shift from roughly 450 billion to 1.25 trillion. And for this to be achieved, there is a good amount of investment which is sort of going to be required. I'm very happy to share that a lot of the activities or actions which the government is taking in terms of the PLIs, I think that's a very big initiative which is happening out here. Many of the sectors where the government has focused on, we already have global competitive, we have achieved global competitiveness in many of these sectors, be it pharmaceuticals, chemicals, automobile. So I think most of them we incrementally, as more and more support keeps coming, I think we will see growth coming by. So I think that's something which is sort of helping us. So I would say that a combination of growth, which is currently more coming out as a push from the government, and then private sector will eventually come as the capacity utilization improve, as the demand goes up. And the second important aspect of the leg of growth is the consumption, which anyways the demographic works in our favor. I think these two are going to be the driving force over the next, let's say, decade or so. In terms of the corporates, I think corporates themselves have become very strong. We are, back to 15% ROEs, having touched a low of 11% 2 years back. I think that's a good starting point. Despite we being impacted by COVID, I think the companies have showcased a good picture here. Most of the companies have seen reduction in their leverage. Their cash flows are improving, so the balance sheets are rightly placed as and when the capital expenditure starts taking place. I think our companies are ready to sort of, in terms of their preparedness from the balance sheet perspective, is there. So I think that's a good starting point as far as the corporates are concerned. Last 5-6 years we've not seen major issues in terms of fraud or corruption, so I think that's a good point to have. In terms of the pain problem in the short term, I think, is the inflation and rising commodity prices. Most of the companies are talking of higher input price, which actually is likely to hurt the demand and growth in the short term. But I think that's something which is, these higher input prices are unsustainable as most economies normalize, as the supply chain issues get over. I think we should be get done with these issues. So I think that's something which is okay. In terms of the valuations, while we are at the higher end of the curve on a 1-year basis, but when we stretch our views over the next few years, it looks reasonable, considering the fact that there is good amount of growth prospects which we are thinking about. Consumption is likely to grow on the back of premiumization. Per capita consumptions are low, and opportunities which are available across various sectors. So I think that's broadly the thought process as far as the outlook for India over the next decade or so is concerned.
Before we throw it to questions, and anyone who has a question, please either unmute and ask the question or type it in the chat box. But I mentioned in my presentation that there's a lot of unicorns emerging in India, a lot of new industries, typically which weren't listed, which are now becoming or coming into the listed space, such as Zomato or Nika or these, I suppose, new fintech, consumer tech type products. What's your view on those? And, will you be investing in some of those names, or waiting and watching the scenario unfold?
So as I said, our focus is clearly on the profitability, the cash flows, on the capital efficiency. Any of these companies showing promise in terms of their ability to achieve these metrics, we are going to be open to look at those, even in these new age businesses, so-called new age businesses as such. But we are also going to sort of compare it to what we already have in our portfolios, and if we have reasons to believe that we have a similar story which is which is sort of available at reasonable valuations and with much better metrics, I think our focus will be on that. So as an example, you spoke about Zomato, Mukundan. For a Zomato, where we today see the path to profitability is blurred at the moment, we have a Jubilant Food where we believe it's almost similar type of a story. The whole food business, the QSR penetration is just about 4% of a 4 trillion food industry, rupees 4 trillion food industry in India. Which means that there is huge opportunity which is available. The company is taking right steps to address that, and after roughly about 1,500 retail stores, the plan is to open 3,000 retail stores. So I think our focus will be on all sorts of companies which basically meets our metrics in terms of their cash flow generation, ROEs, clean good management, and hence we will be sort of open to look at companies and businesses which basically uh, becomes part of our framework, overall framework.
Okay, Vinit, thanks very much for the session. What we'll do is we'll collate any questions that come from our participants and address them via an email. But we thank you for your time today. It's been really good and insightful to understand how DSP and yourself think and operate.
Thank you so much for inviting me. All the best. Bye.